The market is in turmoil. The S&P 500 just entered correction territory. It plunged 1.4% and is now down 10% from its February high. The Dow Jones also took a beating, plummeting 1.3%, a whopping 550 points. This is not a drill, people. President Trump is fanning the flames with new tariff threats. He's slapped a 200% tariff on EU wines and spirits. This is retaliation for their tariffs on US steel and aluminum. Trump is playing hardball, saying he won't back down. The EU and Canada are not backing down either. They're gearing up for a trade war. They're planning retaliatory tariffs of their own. This tit-for-tat is rattling the markets. Investors are running for cover. The uncertainty is palpable. Adding fuel to the fire, we're staring down a potential government shutdown. Senate Democrats are threatening to block a crucial spending bill. This political gridlock is the last thing the market needs right now. To top it off, the Producer Price Index, or PPI, came in flat for February. Economists were expecting a 0.3% increase. Year over year, the PPI is up 3.2%, falling short of the 3.3% estimate. This indicates that inflation might be cooling down, but is it enough to calm the markets? I don't think so. Now let's look at the bigger picture. Market corrections are not uncommon. Since World War II, the S&P 500 has seen numerous corrections. But here's the good news. 75% of those corrections didn't spiral into a full-blown bear market. However, sentiment plays a huge role in market movements. Fear and uncertainty can be contagious. Yardeni Research just slashed its year-end target for the S&P 500 from 7,000 to 6,400. They're citing lower valuation expectations, not changes in earnings forecasts. This tells you that sentiment is turning sour. Sophie's Liz Young-Thomas echoed this sentiment, saying the sell-off is purely sentiment-based. When investors lose confidence, they hit the sell button, regardless of the underlying fundamentals. The tariff turmoil is hitting certain sectors particularly hard. UiPath, a software company, saw its stock plummet nearly 14% to an all-time low. This came after they issued weaker-than-expected revenue guidance. Bank of America downgraded the stock to underperform. The fast-casual food sector is also feeling the heat. Chipotle, Shake Shack, and Cava are all down in March. Tariffs on imported ingredients are squeezing their margins. Consumers might soon feel the pinch at the checkout counter. Tesla, the electric car darling, is not immune to the market turmoil. Its stock is down over 3% today, extending its monthly decline to over 30%. The trade war and fears of a slowing economy are weighing on investor sentiment, but it's not all doom and gloom. Intel, the chip giant, saw its stock rise pre-market after appointing Lip Bhutan as its new CEO. This shows that even in a volatile market, company-specific news can still move the needle. So, what does the future hold? Macquarie Group predicts that gold could skyrocket to $3,500 per ounce in the third quarter of 2025. This is a screaming buy signal for investors looking for a safe haven. Meanwhile, the impact of Elon Musk's Department of Government Efficiency, or DOGE, is being felt in the most unexpected places. Federal job cuts under DOGE are putting a dent in consumer spending in the Washington, D.C. area. The market is a roller coaster, and right now we're on a downward spiral. The trade war, political uncertainty, and slowing economic growth are all contributing to the volatility. But remember, every downturn presents an opportunity. Stay informed, stay vigilant, and don't panic.